My name is Dave Wise. I'm with the Compass Options Trading Room. I have a trading room and an alert service. The trading room, as I just mentioned, runs all day long from market open to market close. And it's pretty rare. Not a lot of rooms do that. But I'm trading all day anyway, so I might as well be in the room and answering questions and answering questions on what particular stocks to take. I answer questions from all the members on stocks that they suggest, show you the technicals on it, show you the whether the institutions are in there or not. So anyway, let's get started. So again, we're going to cover the options room and the alert service, and then we're going to spend some time on options themselves and how best to use them in your trading. All right, so this is just another page to introduce myself. Again, we have a thing called the SPY Super System. I'll cover that. That's basically the Compass Options software that we identify institutions when they're in there, and then we use technical analysis to find when to take what's called a super system setup on the SPYs or the Qs. All right, first thing I got to do is cover the disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky. So you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. All right, we move on. If you have any questions, by the way, I'm going to try to keep the question box up and answer any questions on a timely basis if they're related. But I want to also keep the continuity of the presentation going, so we don't get sidetracked. But if you have questions and you'd like to get them answered, and even if it's after hours, you just put your name and phone number in the chat box or in the question box, or your Skype username, and Rory would give you a call. Rory, or one of the techs down there, will give you a call to answer the question, not to solicit you, but basically just to answer your question. I'll try to answer them all during the webinar. All right, and this is just kind of a graphic show of the what's called the SPY Super System, or the Compass system, that is what it's actually called, and how we find it when institutions are in trades and when they're not. And this is a graphic representation of the actual alert service, what the alerts look like when they come on your phone. You can take the trades on the go, and any trade that we take, not every single trade will be alerted. Most trades will be alerted. There are some that won't be for multiple reasons. If it's like 10 minutes to 4 and I want to take a trade, I'm not going to alert on that. It doesn't give the alert folks time enough to get into the trade if it has to be taken that day. And if I'm in a trade during the day and I don't expect it to last more than half an hour or so, then I'm not going to alert on those. But the other trades and all the other trades will be alerted on, and that's what it'll look like. All right, the first thing I want to cover, and I cover this every time I do a webinar, is just so people understand, or traders understand, what drives the market. Now today, if you were watching the market, it looked nice this morning, moved up beautifully, then pulled back this afternoon, then did nothing but chop around for the rest of the day. So it's really important to understand why the markets are doing that and who's driving those things. So these little marbles here, these are retail traders such as myself, and I suspect most everybody else here in the room is a retail trader. And there's millions of retail traders. And when retail traders are in the market by themselves, we cannot move the market. We can't set a trend. We can't reverse a trend. If we're just in there, we just create chop and chaos. And you really don't want to be in there with just retail traders. You want to take money from retail traders, but you're not going to be able to do it if just the retail traders are in the market. This is what moves the market. This is the big marble back here. This is institutions. So institutions are made up of, most people know who they are, but Goldman Sachs, JP Morgan, Morgan Stanley, all the big investment banks are institutions. They also have what's called algos, which are computer programs that they've got that actually actively trade the market. And they invest in the market, but they also trade the market based on computer programs that are set up looking for specific criteria. So that's part of the institutions. Now, also hedge funds, and there's tons and tons of hedge funds. And it's really important to understand that these funds, they have billions of dollars to put into the market. So when they're in there and the institutional banks are in there, and then you add things such as mutual funds, Vanguard, T. Rowe Price, etc. all of those particular big institutions have billions and billions and billions of dollars, and then you add to that pension funds. So this is what the institutions, this is who they are. These are the folks that drive the market, and our job as a trader, to be a profitable trader, is to know when they're driving the market and when they're not, and follow them in the market. You're not going to take any money from the institutions. You're going to take money from the retail traders who aren't aware of what the institutions are doing when we are, and that's a big difference. And thank you very much for posting that. Yeah, Roy will see that, and he'll be able to contact you based on that. Dennis, it's being recorded. Yes, it is. You get a recording of it most likely tomorrow. All right, so that's what drives the market. So we need to know what drives the market, and when they're not when institutions aren't in there, this is just as important to know when institutions are not in there. It's very important, because when the institutions aren't in it, you want to cut way back on your risk, cut way back on your number of trades. One of the sayings I have in the room is, our objective as a trader is not to make trades. And people look at me funny, but our objective as a trader is to make money. And we only make money by taking the very best trades. And we need to know when the institutions are in the trade and when they're not. Okay, so these, again, the rules to trade by that I have in the room and for the alert service. We trade the best and skip the rest. It's a very simple saying, but it's not that easy to do. I mean, you have to be able to find the best trades, but that's what we focus on. We want to keep our mind focused on finding the best, skipping the rest. And again, our objective is not to make trades. Our objective is to make money. This is really important. A lot of traders feel like, since they're a trader, they need to be in a trade all the time. You don't. Not being in a trade is a trade. I mean, you know, not taking a particular trade is a trade. You've got the money in your pocket. If it goes against you, the money that you saved is actually a win for you. And we need an edge, and this is important. We're trading against millions of other retail traders. So how are we going to beat them? Well, we need an edge in our trading over these other retail traders. So the edges that we have in our room and on the alert service is, and I'm going to go over this. I use a right line compass system to identify when institutions are in the trade and when they're not. So we're only taking trade when the institutions are in there. Then I look to trade relative strength or relative weakness. Now, this doesn't mean RSI. This means how the stock is performing relative to the S&P 500. If you've got the SPY going sideways or down, and your stock is consistently going up on 5-minute candles, it has relative strength. And if you're going short and it's got relative weakness, this is a big edge, because if the market reverses on you, your stock is going to not drop as fast as the market does, because it's outperforming the SPY. Gives you a much bigger edge. You're able to get out of the trade if you need to with a much smaller loss. And we want to trade with the market trend if there is a market trend. We haven't had much of a market trend day to day here lately. We've had a lot of gaps and then choppiness and then a move up and then a move down. But you wouldn't call it a trending day. We haven't really had very many trending days of late. And the last thing that's key is to buy near support and sell near resistance. This means if a stock's moving up, really comes out of the gate flying to the upside, you don't want to chase it, or come down to the downside. You don't want to chase it short. You want to wait until it comes back to a support or resistance level that you have identified, and wait for that to reverse and get back into the original trend, and then confirm that it's in the original trend. That's buying at support and selling at resistance, and it's going to get you in at a much better price, and you're going to have less likelihood of taking a big loss. You still will take some losses. Obviously, everybody takes losses, but we're trying to minimize what those would be. All right, so again, the compass system, this is what the compass system looks like on thinkorswim. It runs on thinkorswim, it runs on Ninja. I use it on thinkorswim. I don't trade on thinkorswim. I trade through a company called Tradier, through a friend end called TradeHawk. But the point here is, you can have the compass system running on thinkorswim or Ninja, but you don't have to trade on either one of those platforms. You're just getting this to get the information. But this is what it looks like, and I'll go over some of the charts with that. So again, the compass system identifies the highest probability trade setups, while sidestepping the setups that look good but will fail more often than they succeed. And we do that by knowing when the institutions are in the trade and when they're not. So again, yeah, we need to know when the institutions are moving, driving the move, and when they're not in there. I mean, you can have a chart that looks really good, and it looks like a nice setup for long or a nice setup for short, and you find the compass system is telling you that the institutions are not moving this. You don't want to be in there. There's way too much risk of reversing. Now the compass system it analyzes complex trading data and displays the data in easily identifiable visual format, as I'll show you. And this actually makes it much easier for people who are fairly new traders with not a lot of skills and technical analysis yet to be able to identify when institutions are in the trade and when they're not. So again, this is how we get an edge over retail traders. You know, individual edges. Again, we only take trades being driven by the institutions. And I repeat this because I want you to understand that high probability trades, these are the criteria we need to have. Only take trades that are being driven by institutions. Only trading stocks that have relative strength or relative weakness to the SPYs or the Qs. Trade in the direction of the overall market trend if there is one. So again, this is how it gives us an edge. Our trades are going to be supported by institutional buying and selling. We're not depending on a bunch of small retail traders to keep our trade up. The stock's going to be outperforming the SPY, and they're going to be moving in the direction of the overall market. So this is a key point to understand about when institutions are in there and why those trades end up working much better than ones when they're not. All right, and this is kind of just what's called a high probability trade setup funnel. This is a funnel that I produced that basically this is just a set of criteria, and if you kind of visualize it as you take a stock, okay, I like this stock, you pop it in the top here and see how many of these criteria it matches. If it matches most or all of these, it's going to drop out the bottom as a prospect, not necessarily a trade, but one that you could trade. So the first thing I look at when I look at a chart, and when I look at a stock, is I look to see if the daily chart and the 5-minute chart are aligned. So if I like a stock on a 5-minute chart, looks real bullish, it's got to have a daily bullish chart, or I'm not going to take it. I'm not going to trade against the overall daily trend just because the 5-minute chart looks good. Because what happens is you can't stay in the trade during the day if it goes against you, because you have no ability to stay in the trade overnight. You don't want to be short a stock that's bullish. So this is important. First thing I look at is to make sure both of those are aligned. Trade with the trend, both stock and market. Well, this basically says if the market's going up and that's a bullish stock and the stock's going up, then I'm going to be looking for bullish trades. But this is fairly obvious. Then I look at to make sure the compass indicators are telling me that there are institutions in here. If the institutions aren't driving this trade, no matter how good these look, I'm not going to take it. I only want to be in there when the institutions are in. Now, they may not be in when I look at it the first time, but I can put it on a watch list, and if the indicators come up and tell me that the stock is now being purchased or sold by the institutions, I can then take the trade. Fourth thing is relative strength and relative weakness that we talked about. And again, enter near support or resistance. So if all of these things are set up, then they're going to drop down here and they become a prospect for you to trade. Right, and this is basically just the funnel method that we just talked about. This is it out in text. 2 green ones here. These are important. Stock to be traded should have daily and 5-minute chart aligned, and the compass indicators must align in the direction of the trade. So if you're going long, the compass indicator's got to tell you that the institutions are buying this stock. Very important. And then the rest of the ones we just talked about, and this is the key thing, and I go over this every single day. Yesterday and today specifically, have patience. You know, it was impossible almost to take too many trades yesterday and today. We actually took a short yesterday with a put debit spread, and we made about 28% in about an hour and a half, but that's the only trade we took. There wasn't any, the market was just chopping all around. I did take one long today for a swing type trade. I'll go over that later, but not a lot of trades to take. I can't take trades when the market is just chopping around like this. I do not have the market tailwind, which immediately takes away one of your criteria for a high probability trade setup. All right, so in the room and on the alert service, typically these are the particular strategies that we use. Obviously, we're going to be using straight calls and puts since we're using options. I also use what's called debit spreads using weekly options expiration. This is what we did yesterday. on a trade, and we made, like I said, about 28% in a couple hours, an hour and a half. I can't remember what it was, but in a short period of time. And I use this current week expiration on all my debit spreads. This is a little unusual. Most people will go out in time on debit spreads, but my experience and my trading view, which tells me that's my journal for trades that I've taken over the years, that debit spreads using weekly options expiration gives you a better ROI than if you go out 2 or 3 weeks. I only do debit spreads. No, I do a lot of, I do straight calls and puts, debit spreads using weekly options expiration. That can be a put debit spread or a call debit spread. I do what's called a time spread over earnings. This is a calendar spread. It's called a calendar spread. This is only kind of trade I take over earnings. This is a non-directional trade. I don't care which way the stock is going to move. I'm just trying to capture the volatility crush that comes out of the premium. When the stock is going into earnings like Netflix did tonight, they jack up the premiums on the puts and the calls. It's called volatility. They add it in there because they don't know how far the stock's going to move or which direction it's going to move. Once the earnings come out, that volatility comes out of the options prices, and you can actually capture the crush in that if you have the right criteria and the stock performs as you expect it to. So again, it's non-directional trade. It captures premium and volatility on an earnings play. It's the only thing I do on earnings, and I take these trades just before earnings. If the stock's going to have earnings tonight or tomorrow morning, I would take the trade late today. Other than that, that's the only time I take those. I also have a strategy called the weekly ATM strategy. This is one I have a video on it. It basically sells puts every week against a longer dated put further out in time, 6 to 8 weeks out in time, so that I can capture premium week after week against a neutral to bullish stock. And I do credit spreads, regular credit spreads to capture premium over a few weeks. I had a loser in one of these today, but typically this is typically an 85% win rate on these credit spreads, and basically it's just simply capturing premium. It's usually trades that don't have to be monitored too closely, because you go out 3 weeks, 4 weeks on them, and you just really what you're doing is you're harvesting time decay every week for your premium. You just collect that week after week. Time is going to favor. The last one is the SPY Super System. This is pretty. I don't do a lot of these. This I only call out in the room. It's when I have basically a SPY SPY that's hit support or resistance level. I know the institutions are in there buying or selling it, and I know the market internals will light up in my favor. Then I'll take the trade in the room. But it's too quick to send out an alert. Okay. Dennis, I only do debit spreads. No, I do credit spreads, debit spreads. Debit spreads can be puts, put debits, call debits. But they're directional. They're directional. All right. Now, what is the alert service? Now, the alert service is designed for obviously day trades and short-term swing trades. This is not an investment service. This is for trades that are going to last intraday or overnight, and sometimes out to as much as 3 weeks. That'd be about the limit of how long I stay in a trade. Most of them are going to be done in several days or a week, but and then we do have quite a few intraday trades as well. But most of them are going to be out in time. Put credit spreads obviously are going to be 3 to 4 weeks, but the rest of them, the debit spreads are usually over 1 day to 3 days. And it's obviously designed for traders who can't watch the market all day or don't want to watch the market all day. Not a lot of people, not everybody wants to sit in front of a screen like I do all day and watch the market. I love doing it. I've been doing it for 14 years, but it's not everybody's cup of tea, but they'd still like to be able to benefit from the market and make some money. And we only take high probability trades. So the highest probability trades, we identify institutional involvement. I keep talking about this. The institutions have to be involved. Market internals, I have some indicators that tell me if the market internals are bullish or bearish. And then we dive deeper into technical analysis to find the best trades. All right, so that's who it's for. This is just a cumulative P&L over this is actually the last quarter of last year, last 3 months, but it's very, very similar. I'll show you some results as we move along here. Now I'm going to show you trades that we've taken. I just arbitrarily picked September through the last month, but the thing that I want to emphasize here is, you know, we have great trade results. I mean, this was a big month. We had 92 win rate. But I want you to notice that if you hear a lot about people selling you services that you're going to make 300, 400, 500, 600% on trades. You can't do that consistently and be consistent. It's just not. It just can't be done. You know, you can get a few big winners, but you're not going to get consistent results. You're going to have big ups, big downs, and it's not good for having consistent profitability. These are the kind of percentages you'll see on the trades that we take. And, you know, I listed them all here, 23, 43, 16, a little bit of a 5 here. See, we had a couple of losers. This was a news event that knocked us down. But again, we did take 108% on STX. That's about as high as it gets. Some of the strangles will get higher than that, but most of the trades are running in the 10, 15, 20 to 40% range. Like we had one yesterday, as I said, a debit spread that was good for about 28% in a very short period of time. And what's an example of a debit spread, Dennis? Quickly say, let's say you've got Microsoft, you like it long, it's trading at, it's trading around 100. You think it's going to go up. You buy the $100 call, you sell a $105 call. You've got a debit spread. So you bought the 100, you sold 105, and your profitability, the maximum that option go to would be $5, and you'd want to be getting into that debit spread for less than 50% of the spread, so less than $2.50. That's the basics of that. I have a video on debit spreads and how to do them. If they're used effectively, they're very, very, very good. All right, so this was the September results. 25 wins, 2 losses. What I use just as a guideline here, I said if you invested $2,000 in each trade, it created a profit of $77.88 over the month. Now, this is arbitrary, obviously. Everybody doesn't invest the same thing, but if I'm going to be just trying to set up comparisons to show what kind of results we're getting, I've got to have something to go by. So this is what I say: if you use 2,000 invested in each trade, it would have produced $77.88 in September. October, you can notice pretty similar: 24 wins, 4 losses, 86% win rate. Again, you can see a few losses spread across here, but again, 32, 20%, 23, 33, 24, 29. It's 43 here. So 61 in JD, that was a pretty nice one. So again, you can see that these are the kind of percentages, gains you're going to see on most of the trades that you take. And because I don't want people saying, I was expecting to get 300 or 400% on these trades. That's if you're looking for that, it's not going to happen here. It's not going to happen consistently anywhere. Okay, Mike, that's good. You want the recording sent over there? Yeah, Rory will pick that up. Excellent. All right, so here's the November trades: 21 wins, 4 losses, 84% win rate, 2,000 in each trade, netted 51.60. You notice that we had 86% win rate here and 44.80 profits. Here we had an 84% win rate, but a 51.60 profit. The win rate was lower, but the profit was higher. A lot of this has to do with the market. When you're trading, if you've got a trending market, you can make more money because you can stay in trades longer. If you've got a choppy market, it's really almost impossible to stay in trades as long. You've got to cut your profits and get out because the market's chopping around so much. So that's why that dude does that. Dennis, you're trying to understand the DXCM. Would that be 15% of the 2,000 invested? That's correct. It'd be 15% of the 2,000 invested. And so these percentages would be, if you had 2,000 in the trade, it's going to be 15%. If you had 1,000 in the trade, it's going to be 15%, and 15% of the money that you put into the trade. So, if you put 1,000 in there, you would have made $150. 2,000, you made 300. All right. So here's the December trades. Very slow month, December. A lot of holidays. A lot of people not trading. Was a crappy market to try to trade. We only had 14 wins and 2 losses. 87.5% win rate. A lot of being patient, being critical here. And again, 24, 13, 5, 36, 63 on Microsoft. That was a good one. VKTX at 30, Microsoft again for 31. Couple of losses. We always have. I should say we have losses every month. I have gone through a couple of months without any losses, but generally speaking, that's not going to be norm. So again, here not a very big profit, but we didn't do a lot of trades either. So I think, that's considering what we're doing, that's pretty good. January was a really nice month. And again, some nice winners in here. There's a credit spread there. We did a meta 25%, a debit spread on DPZ 21%, another time spread. So just to see that the strategies are spread around a little bit. The rest of these, if you just see the percentages, those are straight puts or straight calls. So Zim had 43%, Microsoft 25 here, Mara 65% win rate. And Boeing was a nice one, 96%. I don't get a lot of 96% wins, but that was pretty good. And Gilead, and that was some bad FDA information. We were in that, and it was long and get clobbered. Nothing you can do about that. So 20 wins, 2 losses, 90% win rate. 2,000 invested, 75.05. February, one of our really good months. February we did 24 wins and 2 losses, 92% win rate. In fact, both of these 2 losses came toward the end of the month, but this was a 92% win rate. 2,000 invested, netted 11,745. Pretty nice. And this is where I've just started breaking out the profits from the alert service and the room. Now everything that's in the room, every alert that goes out is also taken in the room, but not everything is taken in the room goes to the alert service. So the alert service will have fewer trades each month than the room, just because of certain criteria that we use. Like I said, if it's 1/4 I can't really send it out, or if it's going to be a half-an-hour trade, I can't send it out. But in this case, we had again 20 wins, 2 losses here. That's 90% win rate as well. So the room was up 69.30. The alert service was up 69.30. The room itself was up 11,745. 2,000 invested. And again, you can see again here we had the percentages don't change an awful lot. They typically run from 15, 20% up to 50%, 60%. We had a 62% here in this Qs, and time spread here was a 50%. So those are pretty nice wins. This just kind of recaps the first quarter of 2024. In the trading room, we had 65 wins, 11 losses, 86% win rate overall, 18,763. So a little over 18,000 if you put 2,000 in each trade. The alert service, 41 wins and 6 losses, so you can see fewer trades. Win rate very similar, and room 12,224 over those first 3 months. So pretty nice, and I'm pretty proud of these numbers, because this is all through all market conditions, and we've been profitable every single year by about the same amount, even when we were trading in 2022, which was a very bearish market. We were able to maintain the same kind of results. So we really don't care what the market's doing, bullish, bearish, otherwise. We trade based on what the institutions are doing and what the highest probability trades are. This was all of 2023 using 2,000 a trade. If you put 2,000 in each trade in the Compass options room, it produced a profit of 60,000, a little over 60,000. So if you use an account, and this is all hypothetical, if you use an account at 50,000, when you first started the year, each trade would use 4% of your account. But that percentage was lower and lower as your account grew. We produced over for the year 120% return on the 50,000, so the account would have been about 110,000 at the end of the year. And so at the end of the year, if you were putting 2,000 in the trade, you were down to less than 2% of your account balance into each trade. Okay. Christina, approximately how many trades do you at one time? You're trying to think through a budget of how much money I need to count to be able to be in all trades. Sure. Typically, I think about the most trades I've ever had on at one time is 6. Generally speaking, and now if I'm doing a credit spread, those are going to be on there they can be on there for 2 or 3 weeks. But for regular trades, most of them are going to be over in 2 or 3 days, and sometimes I'll accumulate a few trades, but I don't think I've ever had more than 6 on there. And most of the time, it's going to be somewhere in the neighborhood of 3. 3 to 4 trades would be open at one time, and then we start, we close them out, and we'll look for another one. But yeah, I would say if you figure 3 to 4, that's probably a good ballpark. All right, and this was just the April trades. I just throw this up quickly. What we had done so far, I haven't even got through today's or anything, but we were 9-1 so far, 47.60 in 2 weeks. Alerted trades 5-0, 29.30 in 2 weeks. So you can see, and again, if you look at the percentages, you're seeing the same thing over and over again here. we did a strangle that didn't work, and then we had a strangle that did work. So, you know, this is what we've done so far this month. This has been a pretty lousy month for trading. If you've been watching the market, you know that it's been pulling back. It's been very tough. A lot of the gains or losses in the market have all come in the morning on a gap, and so day trading becomes very difficult. So when day trading becomes difficult, and I don't have a high probability trade set up, I don't have an edge, I cut back on the trades, the number of trades I take. When it's market's good, then we'll go with bigger positions and more trades. So I just want to I'll cover the alert service here as far as what you get. So when you get an alert, it's going to give you the stock symbol. It's going to give you the option strike price. It's going to give you the expiration date, obviously, and it's going to tell you how much to pay for it. And usually that could be a range. It could be at like $1 to $1.10 or something. Now, if you get the alert and the stock has run away, in other words, let's say I say you want to buy it at $1 and it's trading at $1.35 by the time you see it, just put it in at $1 and see if you get a pullback and get filled at $1. I wouldn't be chasing it. I would wait for it to pull back. Most stocks usually do a pullback, but I wouldn't be just chasing the price up there. And typically what I do is I send out an alert for the buy, and then later on I'll send out an alert for the sell. It could be later on that day. It could be a couple days later. I wait to watch the price action and see what it's doing. Then I'll send out an alert with the sell price on it. And when you put that in, you want to put it in as good till canceled. You want to make sure that order is working when the market opens the next day. If you put an order in as just day trade, it'll go away at the end of the day. And if the market opens in the morning, the stock gaps up, you got a big gain. You could have cashed out for the profit target, but you don't have there as good till canceled. You got to remember to put it back in again. So if you just put it in good till canceled, you'll be much safer. Okay, so to how we get these results, and these are pretty good results. I don't think you're going to find any rooms that have more consistent winning results than we do. For especially percentage-wise, is very, very good. We're able to identify when the institutions are driving a trade and when the market internals are heavily bullish in our favor. Two key things: are the institutions in there, and how heavy are they in there? And so we only take trades when both of these are in our favor, allowing us to align trades with institutions in the market. Now, if the market internals, by the way, which tells me whether there's more stocks going up than going down, then if those are neutral and I still got a stock that has institutions driving it, I'll take the trade. I won't necessarily not take the trade if the market's neutral but the stock is very strong, as long as I know the institutions are in the trade. Okay, so just briefly, how do we know when the institutions are in a trade? And this is what the Compass system does for us, and we do what's called a triple screen assessment. Some people call this fractal, some people call it multi-time frame. But basically, what we do is we look at three different things. We look at momentum on current time frames and multi-time frames, three different time frames. We look at the trend on three different time frames, and we look at a money flow, a money flow indicator. It's not specifically money flow. It's a variation of money flow. But we look at all three of these things across multiple time frames. When you have momentum moving up across multiple time frames, trend moving up across multiple time frames, money flow moving up across multiple time frames, the likelihood that move is not being is being created by institutions is very, very high, well up into the mid to high 90s that they're in there driving that trade. So that when we see that, we can identify it on the Compass system by looking at our color screens. All right, so that's how we identify that. I'm going to go into the Compass system a little later, but I just want you to understand what the system is looking for. It's crunching a lot of numbers here to find this information. All right, and this is briefly just the Compass system here. This is just a Tesla trade we took, and you see all the green here. This is the long-term trend. This is a multi-time frame momentum. This is the current time frame momentum, and this is the money flow. And when you see all green or all green and blue, this tells you that the institutions are buying the heck out of this thing right now. This was Tesla. This is a trade we took. You see this compression right here. This is a 5-minute chart. It popped up right here with this little pop out of the box signal. This little pink arrow is created by the Compass system to tell us when a compression is being broken. This is when we took it, and this is the this is the movement we get. Now these candles, by the way, are Heikin-Ashi candles. I use Heikin-Ashi candles when I'm looking to get into a trade because Heikin-Ashi candles show us flat bottoms. I have a video on all of this kind of thing, but it just is a way to find basically a reversal that's being confirmed. But you can see how nice that worked. So that's what the compass system looks like. And we'll go over some of these here in just a little bit, but I wanted you to see how this is, how this looks and how easy it is to spot them. Now, if you get a lot of color changes like we had today, there were just nothing that looked particularly good as far as the colors were concerned. It was going back and forth between red and green and blue and yellow. It was a mess. So you know the institutions weren't pushing anything. All right, so I'm going to spend some time here in options. We'll probably spend 15, 20 minutes talking about this. I can't obviously don't have time to go into a lot of detail on them, but I do want to just cover them so for folks who are maybe familiar with them but not really too deeply, or somebody who doesn't know about them, I'll show you what they are. So first thing I'm going to show you is an option chain, and most everybody here probably knows about an option chain. This is Bristol-Myers. This is what an option chain looks like. When you look at an option chain, everything on the left here is these are the calls and these are puts. All right, so the calls are over here, the puts are over here. This is the strike price. So this is what the strike price would be. You see it goes up here in increments of $1 for the most part, well 50 cents actually. This is Bristol-Myers. And over here you have the bid and the ask. This tells you what somebody's bidding for this. So if you look at the 56 calls, for example, they were bidding 6 cents and somebody was asking 14 cents. This is the spread. So this is what you're trying to get in between when you take something that. If you were trying to buy it, you try to buy it for as low as possible, between 6 and 14. If you're trying to sell it, you're trying to sell it for as high as possible. Now, the one other number in here is called the delta. And you see this delta, that's in the white number right here. Right now, if you look at the strike, the price here was 53.79. So about close, 54 was pretty close to the at the money price, was called at the money, which is what that strike was. You see that the delta here is 52 on this $54 call. So it's $52, 52 delta, which is, and I'll go over what delta is. But as you move into the money, you notice the 54s, the 53s, the 52s. These are in the money. The stock is above those price. You see the delta gets bigger and bigger, and as you move away from the at the money, the delta gets smaller and smaller. You know, if you look at it over here, you notice you add up the delta on the call and the delta on the put, it comes miraculously comes to 100. It's always going to come out to 1. So this tells you what the delta is on Bristol-Myers. Okay, so those are what you're looking for. That's the information you want. The strike price. These are the expiration dates here. They're always this is in weekly, so every week, every Friday, there's another expiration date. So if you move across these and click on them, you're going to get the different prices for those that particular stock. Now, there's one other thing here on the option chain. This is another screen. What I've included in here is the volume and the open interest. It's over here. See, this says OI is open interest, V is volume. That the open interest is how many contracts are outstanding right now on Bristol-Myers for this strike price on this date. All right, so for March 15th, and this is old, obviously, we had 617 contracts traded today, and the open interest was 11,867. So this is how many traded today. This is how many contracts there were at the beginning of the day. Open interest always includes all the contracts that were available when the market opened, but it does not include the contracts that have been added today. That's why you have two separate numbers. At the end of the day, they'll create a different open interest. It'll be all the options that are still open at the end of the day. Right, so that's open interest and volume. And this is kind of important because you want the volume to be heavy enough so that when you get into a trade, you're able to get out of it okay. And the more open interest there is, the easier it is to exit a trade. All right, so that's an option chain. Calls over here, puts over here, and the rest of the information is that you're interested in is usually delta and open interest and volume. All right, so we're going to talk about options here. You know, I don't want to be too confusing here, but I just want to go over some basics. We're going to talk about options, what makes up the premium, I want to explain intrinsic versus extrinsic value. We're going to cover some of the Greeks. I'm not going to go into really deep diving into Greeks. We're going to cover the ones that I feel like are important. Strike price and expiration dates, which ones to take. Volume and open interest, we talked about that already. Primary option trades that we use. And we're going to talk about which option strategies are bullish, which are bearish, which are neutral, and what setups to use for these particular things. It's important to know what option strategies to use if the market's bullish, if it's bearish, or if it's neutral. There's different option strategies for each one of these setups. All right, so what are options? Okay, well, a lot of people think options are just like buying stock. They're not like buying stock. Options come with what's called rights and obligations. You can buy them or you can sell them. Right, so if you're buying a call or a put, you're long a call or a put. So in other words, you're buying a call, you're expecting the market to go up. If you're buying a put, you're expecting the price to go down. You can sell them. You can sell, when you sell one, you're short a call or short a put. So if you sell a call, you're expecting the market to go down. And when you sell a put, you're expecting the market to go up because you're going to collect premium when you sell those things. And by the way, selling puts or selling calls, especially naked when you don't have a spread on, should never be done. Selling puts only if you really want to own that stock at a lower price. So again, buying a call is bullish, selling a call is bearish. Buying a put is bearish, selling a put is bullish. This is how how options work. Now remember, they're made up of several different things besides just stock price. All right, so what makes up an option price? This is important because when you buy a stock, you're paying a price for it. That's what it costs you. If you buy Microsoft at 100, it's $100. There's no time involved with it. There's no time decay that comes with it. None of that stuff. There is some volatility in the price, but that's built into the stock price. So basically, options can be at the money. So if you buy, if Microsoft's 100 and you buy a $100 call or a $100 put, that's an at the money option because the strike price is exactly what the stock's trading for, or close to what the stock's trading for. You can have it in the money. If Microsoft is trading at 100 and you buy a $95 call, that's an in the money call because the stock is $5 higher than that call. And if you buy a $105 call when Microsoft's trading at 100, that's an out of the money call. That means the stock has got to move up $5 just to get to your strike price, right? So that's what at the money, in the money, and out of the money mean. And this is important because there's the way you buy options, there's certain ones you should be buying and certain ones you shouldn't be buying. So what makes up the option premium price? When you pay for an option, what's it include? Obviously, it's going to include the stock price. So again, back to the Microsoft trading at $100. All right, if I buy a $95 call in Microsoft and the stock's trading at 100, then if I'm buying a $95 call, that call has some value, right? It's got what's called intrinsic value. The intrinsic value is the difference between the strike that I took and what the stock's trading at. So if I took a $95 call and the stock's trading at 100, I have $5 of intrinsic value. In other words, that option is worth $5 just because the stock price is $5 higher than that. That's called intrinsic value. All right. So no matter what, I'm going to have $5 of value in that stock as long as Microsoft stays at 100. The next thing is what's called implied volatility. The implied volatility is extra premium that's added to the option price based on what the market makers think, how fast they think that stock's going to move, how much volatility is in their stock, how much is it moving up and down in a day, in a week. That's implied volatility. So they jack up the price of the premiums, they add implied volatility to it. And then the last thing is time decay. Time decay is how much time is there between now and the option's expiration. So if I have like a $100 Microsoft call that expires in 4 weeks, the time decay is relatively slow because I've got a lot of time until that option expires. If I've got a Microsoft $100 call and now there's only a week until it expires, the time decay is going to be very, very fast because the amount of time for that stock to move has been reduced by a lot. So the time decay that's going to be built into that premium is coming out of there. So those are the things that make up your basically make what's an option price. There are a few other things. There's a thing called Black-Scholes. I'm not going to get into that. All right, so that's what makes up an option price. So again, to compare intrinsic to extrinsic value, and this is really kind of important. We're going to use, in this particular case, we're going to use a $50 option at a stock trading at $55. All right, so a $50 option at a stock trading at $55. Well, obviously the option is worth at least $5 more than the $50 that you're getting, because the stock is already at 55. So it has an intrinsic value of $5. So when you look at the option price, it might say, you know, $5.75 or $6. If that's the case, then you've got $5 of intrinsic value built into that premium. All right. Now the extrinsic value is the option value. So if let's say we paid $6 and the stock's trading at 55, we bought a 50 option, we've got an extra $1 we're paying for that above what the intrinsic value is. That's the extrinsic value. And that's all you have to do is just subtract the option value minus the intrinsic value, and that gives you what your extrinsic value is. And you want to pay as little extrinsic value as you can, because that's not part of the intrinsic value. That means that particular portion of the option price is going to be impacted by time decay and volatility changes. All right. So again, it's also important that the volume of options trade the strike price and expiration date as well. We talked about that for open interest. But when I buy an option, I'm going to take a delta of about 70, 65 to 75. I want that stock to move pretty good, which means any option I take when I enter a trade is going to be in the money. They're always going to be in the money. I'm going to have some intrinsic value in that trade, in that option. Now the Greeks, I'm just going to cover these three: the delta, theta, and the gamma. The delta, okay, the delta, we talked about that, what you saw on the option chart, right? The delta will tell you how much the option price moves in relation to a stock price. So if the stock price moves $1 and you have a delta of 50, it means the option is going to go up 50 cents. So when I take a delta of 70 on the stock, for example, if the stock moves $1, my option price is going to go up 70 cents. That's what delta is. It's basically how much the option price moves relative to how much the stock price moves. The theta is the time decay. This is the decrease in value of the options as the expiration date approaches. As you get closer and closer to expiration, this time decay is going to come out of that option price, and it's going to cut down on the value of the option. And the last thing is gamma. This is the rate of change in delta. If you've got a stock that's really, really volatile, let's say the delta is 70, and the stock all of a sudden takes off with really big green candles, the delta can go from 70 to 80 really quickly, because the gamma is the rate of change in delta. And if the stock's moving up fast, it's going to move, the delta is going to move up fast. And this means when the gamma is high, it means the option price can change dramatically with only a small price change in the stock. Now, I use an example here. If you have a stock that all of a sudden a news event comes out and the stock shoots up from $20 to $27 in 10 minutes, all right, you're going to have a huge amount of gamma here, because the stock is ripping higher. The delta is going up really fast. And in this particular case, a lot of times the option can actually move faster than the stock price. So the option could go up $1.50 when the stock only goes up about 25. All right, so it's the gamma that's causing that. Now, this is a double-edged sword, because when the stock price starts to level off after this big, huge run-up, the gamma is going to drop. The delta is going to drop. So the stock price, which maybe the option price ran up from $6 to $8, even though the stock is going sideways now, the option price is going to start coming down, because the gamma is reducing the delta. And it's a little tricky, but that's just something to be aware of. But if you've ever traded options on a stock that was moving really quickly, you might notice that the stock price wasn't even keeping up with the option price. The option was going up faster than the stock price. All right, so these are the primary option strategies. I don't use them all, but these are what the primary option strategies are. Obviously, long calls, long puts. Put credit spread, or call credit spread. Anything that's a credit brings the money into your account. A put debit spread or a call debit spread, we talked about those. I do calendar spreads, which I call time spreads. That's a type of calendar spread that I use over earnings. Then there's condors, neutral trade, butterflies, strangles, and straddles. This is I mean, there's other ones, but this is most of the ones that they look at. I don't use any condors. I do butterflies, but I don't really call them out in the room. They're a little bit trickier for most people. But we do some strangles and some straddles. So those are the primary option strategies that I look at when I look at a trade to make a determination which way should I go on this. All right, so these are bullish and bearish and neutral option strategies. So if you like a stock long and you want to use an option strategy, here's what you can do. You can do a long call. You can do a short put to bring in premium. You can do a put credit spread to bring in premium, or you can do a call debit spread. Those are all bullish strategies using options. Bearish, you're gonna look the same as this. Short, you can short the calls. Never do this. You can take long puts. You can do a call credit spread or a put debit spread. All of these strategies are bearish. All right, so this is kind of a little breakdown. What are the neutral option strategies? Condors. Condors don't care which way the market moves. Straddles and strangles don't care. This condors is looking for a stock to stay kind of in a tight range. They don't really want a big move. Straddles and strangles are looking for a big move. They don't care what direction, but they want it to move big one way or the other. And then time spreads are a neutral strategy. This is done over earnings. We don't care which way the stock moves after earnings. We just want it to move within a relatively tight percentage up or down. All right, so these are the strategies that you can use once you've determined what a trade is. Because one of the thought processes you go through is, if you look at a stock and you like it long, then you have to decide, okay, what do I want to do? Do I want to buy the stock? Do I want to buy a call? Do I want to do a credit spread on it? Do I want to do a debit spread on it? There's a lot of things that go into this, and a lot of times I'm trying to find what's the best strategy for these things, because each one has advantages and disadvantages. Okay, so here's the setups, and again, I'm just going to go over these quickly. When you look at the video again, you can go over these and make sure. And I have videos on all of these. But a put credit spread, you're selling a put and buying a put at a lower strike price, and you receive a credit. A call credit spread, you're selling a call and buying a call at a higher strike price to receive a credit. A put debit spread, now this is debit, so it's going to cost you money. Buy a put and sell a put at a lower strike price for a debit. That's going to cost you a debit, all right? And that's a bearish strategy. And a call debit spread, buy a call and sell a call at a higher strike price for a debit. You're expecting the market to go up. You're expecting the stock to go down. Credit spread, you're expecting it to be neutral to bullish, and call credit spread neutral to bearish. Calendar spread, this is what we do on time spread. We sell a put or a call at the near expiration date, this week's expiration, and buy a call or a put with a later expiration date out in time. So you've got you've basically got same strikes, different expiration dates. That's what a calendar spread is. And then the time spread I talked about, this is a specific calendar spread to use on earnings. We're selling this week's calls, for example, and buying next week's calls. And this is how we capture the time decay and the volatility crush. And a strangle, you're buying a call and buying a put one strike or more away from the money using the same expiration date. That's a strangle. So if you had $100, stock was trading at 100, you'd buy a $101 call and a $99 put. All right, and that's how you would get. That's how you create a strangle. A straddle is the same thing, except if the stock's trading at 100, you're buying a 100 call and buying a 100 put. So that's a straddle. You're looking for the stock to move up big or down big enough to cover the cost of the call and the put that you bought. Strangles are cheaper to buy because they're out of the money already. Straddles are more expensive, but they can move better because the stock doesn't have to move as much to be in the money because you're already in the money. All right, so those are the option strategy setups. And choosing the best auction price, and a lot of this depends. You've got to look at the option chain and kind of decide where you want to take the expiration date. But typically, when I'm taking a trade, I'm looking out 3 or 4 weeks for my expiration date. I'm taking a strike price that's going to be in the money with a delta of about 65 to 75. 65 to 75 delta. So the strike price is going to be in the money, and an expiration date 3 to 4 weeks out. This is general. This is generally what I'm looking at. I'm going to go through and look at expiration dates, try to find the best price for the option I want to take. And a lot of that depends on, what the bid-ask spread is, et cetera. So I may say, okay, I want to go 1 week further because I can get a better bang for my buck 1 week out further. But that's what you want to do. And I'm taking in the money calls or in the money puts. I'm always taking in the money calls, in the money puts with an expiration date, 3 to 4 weeks out generally, with a delta of 65 to 75 or so. All right, let's see if we got some questions here. How do you defend a credit spread if it goes against you? That's not a tough question, but it takes a little time to answer that. Typically, if you can leg out of a credit spread if you know how to do that, but it adds risk to your trade when you do that. So if you're short a call or short a put and you've got a longer put, you can actually buy back the short put and ride the long put down. But the market has to keep going in that direction, because if it reverses and goes against you, you end up losing more money. So for most people who are just doing credit spreads, the best thing to do is it goes against you is just to exit the trade, take the loss. I generally think that options with higher deltas, 67, a better value out of money when with deltas around 50. Yes, I do. And the ones at the money have moved better, but the point is you have more intrinsic value in the money calls or in the money puts, which means if the stock starts to move against you a little bit, you're not losing as much value because a lot of your option price is intrinsic. In other words, it's built into the price of the stock. If you're at the money or out of the money, everything that you're paying for that particular option is being hit by time decay and volatility crush. You're losing money on the entire value of that premium that you took. When it's in the money, you're only losing value on just a small portion of it. Dennis, you're welcome. Does the service send credit spreads alerts of buying only? No, we send credit spreads alerts, debit spread alerts, time spread alerts, straight puts and straight calls. The only thing I don't send out right now yet is strangles. I'm going to be doing that pretty soon. But credit spreads, debit spreads, straight calls, straight puts, time spreads, I'll get alerted. Okay. All right. So that kind of wraps up earnings options. I didn't want to spend too long on this. Again, I could go on for a couple hours about this, but I kind of want to give you an idea to hopefully make people understand. I think one of the nicest things here is this, knowing what particular option strategies are available to you based on what your consensus is of what the stock's going to do. All right, so I'm going to show you now, this is going to show you the compass system. It's going to show you some of the trades we've taken lately, why we took them, how they worked out, et cetera, so you can see what we're looking at. All right, so this is Lulu. We just took this fairly recently. This was a put debit spread, and we took it overnight, not that long ago, in April, early April, I think. But this was the compass system here showing Lulu on a daily chart. All right, so where do we take the trade? Well, I took it right here, and if you see how the stock is compressing right here. This was earnings. See how it's compressing right here, and then you see how it breaks down here. The stock starts to break down, and notice that we went from a multi-time frame momentum from blue to yellow. That's bullish to bearish on multi-time frame. Now the current time frame momentum was bearish the whole time. So we got red and yellow here. This is a short setup. This is telling me the institutions are selling this thing. So we took it overnight, and we entered for $1.92, and we get out the next morning for $3 a contract, 192 and out for $3. So it was 56% profit on that Lulu put debit spread. And we did a debit spread on this because it's cheaper to take a debit spread than it is to do straight puts, and it was a fairly expensive stock. So to buy straight puts on this thing would have cost in the neighborhood of about $2,200. We were able to get in for $1.92 or $192 on a debit spread. So this is one of the reasons I took that, because I wanted folks in the room to be able to, and folks in the alert service to be able to take the trade, but I don't want to tell them that it's going to be $2,000 a contract. So I took a debit spread in that particular case. This was Shake Shack. We were in 2-day trade here. This is another daily chart. Again, you look at here, can you tell the institutions are buying this thing? You can see this big gap up here in earnings moving sideways. You see how it's compressing. But we took it right here as it started to roll off of this this little white line right here. And we took it long right here. Everything is telling us it's in there to be long. So we took it and we wrote it up. 26% profit in 2 days in this thing. And, you know, get to the high here and we get out. But we were only in this for 2 days, just up into here. But still 26% is not bad. All right, this was workday. Now this was a little trickier. And I'll show you, this was the long-term trend. It was bullish. It went to yellow here, but it was mostly bullish. See the multi-time frame trend. You see how it was going yellow to blue. We had bullish, bearish, bullish, bearish, but it was switching here back over to bullish again. And I had current time frame momentum was good. So I was okay with taking this if I got a proper technical setup. Now this shaded area here on the compass system is called a dynamic compression zone. This is the compass system creates this compression zone when it sees a compression it can be identified when you break out of it, which is what we did right here. So that's what we took it, workday. And we were in this for 5 days and we rode this thing up for a 30% profit. And you see how it switched back to yellow here? This was one I had to watch. But my current time frame momentum, which was on the daily, stayed green, stayed bullish the whole time. So I felt comfortable with that trade. GCT, this is another one I actually just got in today. Again, but this was GCT. We took this 2-day trade for 26%. Everything's green or blue. Dynamic compression zone is coming out of dynamic compression, but it's still compressing here. We took it here in this pop, and 2 days and out. MDT, this was a 25% profit on a swing trade here. You see how this went yellow to blue? See how this train changed to blue right here where everything else was green? I knew the current time frame momentum on the daily had gone to institutions buying. Bought it right here and rode this thing up, 25% profit on a swing trade right here on MDT. Just so you can see what the compass system looks like. This is Vertex, same thing. Again, this is what we're looking for. And this is telling you that the stock is bullish. If this was yellow and red, even though it popped up, you wouldn't be interested in something like this, right? But it popped up. We made 30% in 3 days on this thing, and a pretty nice trade. And you can see how it's all of a sudden shifted to mixed over here. This was McDonald's, $8.30 in, out for $11.30, or just overnight. We $3 profit per contract, 37% gain. Notice everything's green here. Now the stock is moving sideways. The institutions are buying it, but the price is not moving yet. But here we get this breakout of this dynamic compression zone. The institutions are buying it. We can see that. So we buy it here. We're in overnight, and we get out right here on just this one candle. Okay. Crowd, same thing. And I won't go on too long about these because they got to look. One of them is going to look the same. This was Amazon. Same thing here. We get the institutions buying. We did have a long-term trend that was neutral kind of, but we like this break and this pop out of the box signal. We took that. All right, so I'll just rip through these. This was ENPH compression, break to the downside on a pop out of the box symbol, 20% in an hour. This is a 5-minute chart. We were in this for an hour for 20%. Institutions selling the heck out of this thing. All right, and Verizon, 50%. This was a nice one. We get into this for 45 cents. Verizon is inexpensive for the options, $45 for a put, even though it's in the money. I think we're just out 2 weeks on this, but this we got 50%. We get in at 45 cents, out at 67 cents. So we in at 40. Took 10 contracts, it was $450. An hour later, you get out for $670 on Verizon. Obviously, the institutions are selling the heck out of this thing. And this is just a SPY super system setup that I told you about. Again, you can see here that the system, we're getting a pop out of the box signal. Everything is bearish. Get in here and we get out right here. Just a very short trade. These are 5-minute candlesticks here. And this was a Tesla trade we took overnight. We had on the 5-minute chart, we had a pop out of the box signal here at the close of the day. Everything was red. The institutions were selling. We decided to take a chance and take a put overnight, and it dropped from $120 to $112. Big explosion in the options. They rocketed up. Now these all look good, and you have to understand that we don't win every single trade. It's important to understand that there's always going to be losses. Everybody has losses. We have losses. I'm not doing 100% win rate. I'm doing more like 85 to 90% win rate. So there are losses. All right, let me just check for questions here. When a trade doesn't work, is there usually a common reason? News, signals, conflict. You know, there's some, Christina, there's some reasons for them. Sometimes there's just, there's just no reason for it. Yeah, news will do it for you. News will, any kind of news event, which would be like earnings or something, that takes over any kind of technicals. But news will do it. Signal conflict, not necessarily. And listen, a lot of times it's just that the institutions have changed their opinion of the stock, and it'll reverse on you. Where on the compass screen indicate institutional involvement? It's basically the combination of the colors, John. If you're looking at the colors, if it's all green or blue, or all red or all yellow, all green or blue is bullish, all red or yellow is bearish, because it's using multiple indicators to tell you the institutions are in there or not in there. Presently, you rely on NASDAQ level 3 book view for institutional bids and asks. Yeah, but you see, the thing was, when you're looking at that, that's like level 2, level 3, but you're not seeing what's happening over multiple time frames. This is the problem with just looking at a current time frame for institutional involvement. Institutional involvement isn't a one time frame thing. It's looking at, you have to look across multiple time frames to see what they're doing. Because you could get a bunch of institutions that are selling right now in a 5-minute, but everything else is bullish, and then it goes back to bullish on the 5-minute. Then you can be back in, because you've known all along that the multiple time frames they were still bullish. Which was, we use the 5, the 15, and the 45 on the 5-minute chart, and the 1 day, 3 day, 9 day on the daily chart. Okay, so that's the strategies we use. Again, straight calls, puts, debit spreads, time spreads, weekly ATMs, credit spreads to capture premium. That's the strategies in the room and on the alert service. And I will put this offer out there for you if you're interested. This is the alert service right here. The alert service will include 1 month live in my trading room. Again, I'm in there every day, 9 to 5 or 9:30 to 4, basically. We have a Discord chat room. Obviously, you get alerts. We have a Discord chat room where we have 2 other professional traders that have audio on, that you can ask them questions. They post charts as well. And then I have about 25 videos on anything to do with the compass indicators, how to find the highest probability trade setups, how every single strategy that we use is to find time spreads, put credit spreads, debit spreads. I've got videos on all of those. All right, so this is what you would use if you wanted to get the alert service for a full year for just $9.98. And you saw the profits we took, so that's a pretty good deal. 50% off if you want to try it for a quarter, just $3.96. Put save 200. That's the alert service. This is the room, and the room includes the alerts. So if you're in the room, sign up for the room, get the alert service. You get obviously the live trading room access for a year for $11.98. That's save 50%. You obviously get the Discord chat and the alerts, and you'll get the videos as well. And lastly, this is the actual compass system that we just talked about, which gets installed on your thinkorswim on Ninja platform. Brightline installs that for you. You don't have to do anything technically to put that on. They just take over your machine and put the software on there. It comes with a bunch of scanners, and again, you get, if you buy the system, you get a month in the room for free. You get the Discord chat, and you get the videos. So all of that comes with the compass trading system if you get it. So those are the offers we've got on these the 3 things: the alert service, trading room, and the compass trading system. You got all 3 here. And again, this is Rory's numbers here. And if you have any other questions that I haven't answered, you can just pop your name or number here in the chat box, and he will get it back to you on that. All right, so let's see if we have any other questions. That pretty much wraps it up for today. I hope the options information was a little bit helpful. I try to do as much as I can in a relatively short period of time, because I don't feel like people want to spend 2 hours, but I do want to kind of cover some of the options information. So I hope you found it useful. That was fun. You're welcome, Christine. That was fun. Great. Michael, the AI system, you want to talk to Rory about that? Just give Rory a call, 786-732-4656. He can go over that. The auto trading system, he's an expert on that. He can answer any questions you've got on that. Christina, thanks. I'm glad you enjoyed it. you know, I'm not a professional presenter. I'm a trader. I'm just, you know, I'm not a marketer. I'm not a professional presenter. I just trade. I've been trading for 14 years, and you know, this is what I love to do. And I really love the system that we've got here to find these high probability trade setups. So, you know, I want to share it with people. It helps me. To be honest with you, it helps me to be running a trading room because it's very isolated trading on your own. Trading in a room is great because you get a bunch of people working with you. They're asking you, look at this stock, look at that stock, asking questions. It really helps to keep me sharp, to be honest. Christina, you did great. I appreciate it. Thank you very much. Thank you very much. So again, there will be links in the chat box to all of the offers we have here. That I just put out there. Rory's put the alerts out there. If you buy the Compass system, by the way, you're going to get, your chat, the screen's going to look exactly like mine does. You're going to have all the indicators. Everything's going to look exactly the same. It'll be identical to the platform that I use. And in the trading room, I have that Thinkorswim platform up here all day long. Let me see if I can show it real quick. Yeah, this is what I have up during the day. This is the futures right here after hours. But this is what I have up all day. You can see all the choppiness today in the ES. You notice a bearish, bullish, bearish, bullish. Very tough day for trading the futures. I don't really trade futures very much. These are some of the scanners that we've got. So this is what it would look like. It would go on your Thinkorswim platform, and it would look exactly like that. The one on the Ninja looks different, but the criteria or the indicators are exactly the same. All right, so that's the kind of a wrap it up for today. I appreciate you taking the time to spend with me here today as well. So we will hopefully see some folks in the alert service or in the room here in the near future. Have a great one. Is there a scanner to find trades, Dave? Yeah. Let me show you real quick here. I have multiple scans over here. This was what's called an RLT scan. This is looking for those pop out of the box signals that we have. You know, and if I click on the scan, if I click on this, it will show you the results. See the pop out of the box symbol right there. You can click on each one of these, and it'll take you directly to the chart. Now, this is a 5-minute chart. That's Pfizer right there. This was the pop out of the box signal. That's why that showed up. And I've got several scans here that work for the room. This is looking for bearish trades. This is probably not going to show up very much right now, especially since it's after hours. But yeah, those are the scanners in there. There's several of them. I've got the new yearly highs here. I can switch that to new yearly lows. We have all of that there as well. So if I can find the stock here, I'll show you. There's Lab P. All right, this is no volume on this thing. Yeah, see, there's no volume on any of these today because the market was pretty bearish. So there's nothing here that's going to be particularly strong. So I wouldn't be using any of those today. But yeah, there's a lot of scans, and they're going to be, you know, it's used for different ones. I have one for cascading up and cascading down, which so if the market is going neutral, sideways to down, you can look at a cascading up scan, and it's going to show you all the stocks that have had at least three green candles in a row. They're going to have relative strength to the market. So that's important. This would be on the daily chart right here that I'd be interested in looking at these. Switch to the daily, and you're going to see this Las Vegas Sands, this earnings today, bearish, big bearish move down right here. And there's Walmart. See the bearish candle right there pop out of the box symbol on the daily, giving me a breakout of compression on the daily to the downside. Same thing with Disney. So yeah, that's how I use those. All right. So again, I appreciate everybody's questions. I appreciate you being here today. So thanks very much for attending. I appreciate it. Look forward to seeing some folks in the alert service in the room pretty soon. And good luck trading.